Kia ora. I'm just going to take you through the deferred tax exercise on Mokoia Engineering Limited. So we've been given a number of details. Firstly, what the profit is. Okay, so the profit has been provided as, so we put the profit figure in, okay, which is 1,555,300, and then we work through the various items. Okay, they tell us that accrued wages is of 269 have been accrued to get to that profit. The amount of accrual will only be deductible for tax purposes when paid. So since we haven't paid it, we'll need to add it back to that profit to work out the tax. Okay. The second thing is they say we've got unearned sales revenue of 265, and we received in advance. Okay, this is amounts as taxable in the hands of Mokoia Engineering Limited in the year of receipt. Okay, so really we haven't recognised it in the profit because we've got it in the balance sheet as a liability because it's income we haven't earned. All right. Okay, so we need to add that back for tax purposes. Thirdly, in order to secure a rental, a property to rent or to lease, we've had to pay some money up front, some advance rent. Okay, we're showing it in the balance sheet as an asset, but so we're not recognising it as an expense until that rent has been utilised. All right, but for tax purposes, we're allowed to claim it. So that's a plus. So we will deduct it from that figure before we work out our tax. Fourth, there's an item of plant. All right, we're going to have to do a bit of working on this one. Okay, so there's a working thing down the bottom here. We've acquired it for 1.65 million. For accounting purposes, we're writing it off over 6 years, so that's 1/6. For tax purposes, we're allowed to write it off over 4, so we can actually claim more depreciation each year, and that's the tax effect, right? Okay. Notice that we actually acquired it in the beginning of 2017. We're actually doing things for the end of 2019, so that was the beginning of the year before. Okay, so we're going to have to do a couple of years in a row just to get us to the right point, bearing in mind really that the depreciation each year for accounting purposes will be same, it's straight line, same for the tax purposes, straight line as well. Okay, but after 4 years we won't be claiming any more depreciation, and by year 6 under both ways will be fully depreciated, and that's when obviously the tax difference disappears. Okay, and therefore the closing balance in the current year are these figures here. All right. Okay, so what we know now is that the tax difference for the year, it's only 1 year we're looking at, is we can claim more for tax purposes. We can take that off the profit we've calculated. The fifth thing, there's an allowance for doubtful debts. So that figure there has been reduced by an allowance for doubtful debts. The IRD doesn't let us write off doubtful debts until they're genuinely bad, so we need to add that back. All right, get the picture? Right, the sixth thing isn't a timing difference. It's actually just an item that we've claimed as an expense. Let's say that the who we've donated the money to isn't a authorised or registered official charity, therefore the donation isn't recognised as a tax deduction. Okay, so we have to add that back. The seventh thing is that we have received a dividend from overseas, and that dividend isn't taxable. So we've included it there. There's no timing differences. It's just we don't have to pay tax on it. So we can deduct that off before we calculate what the tax is. All right, so we're up to the eighth item, and that is rent that we know it's interest we've earned, but we haven't received it yet. We've included that income in the profit, but the IRD says we don't need to pay tax on it until we actually receive it, so we can take it off again. All right, it's only a timing difference, so that's the timing differences are down here, and just the non-deductibles or non things you don't have to pay tax on are up here. Okay, so that'll give us a total for that, which will give us the amount that we, for tax, so the IRD will be expecting us to pay tax on that figure there. All right, okay, or the tax is on that figure there. They're actually going to expect us to pay tax on the taxable income down here, right? So, but for our accounting purposes, that would be the taxable figure, all right? So that at 30% is that, all right? So that's the amount we show as tax, income tax expense, all right? It's going to be a debit journal entry. That's the income tax expense we show in the profit and loss or the income statement, right? Okay. That's the adjustment for filing the tax return, okay? All right. So taxable income will be this amount here less that amount there, okay? And the tax on 33% is that, okay? So basically the liability being tax payable, actually what we're going to put as a liability, because that would be the tax showing on the tax return, would be that amount, and the difference being the timing difference, which is the deferred tax, okay? So that is the journal entry, okay, that we need to do for tax and deferred tax, okay? So that's all well and good, okay? They talk about also looking at the balance sheet way to working out what the deferred tax is, okay? We're going to come up with the same figure, all right? So pretty much the figures as per the accounting statement of financial position, okay? So what we do there is we compare what's in the balance sheet to what the figure is for in the tax, right? So we know that the plant for tax purposes is this figure down here, all right? Okay, that figure there. Okay, we know it's that figure there, all right? So that goes there, all right? The difference is, okay, is 275, okay? And that's going to be, we'll show that as a liability, right? But it's only the tax on that amount, okay? But the difference between those two, the tax on that is a deferred liability, okay? Accounts receivable, interest received, okay? In interest receivable, we've claimed all that for tax purposes, so in the balance sheet it would be 0, okay? And again, the difference is 250, okay? Rent prepaid, okay? Again, it's showing in there. We've claimed it all for tax purposes, so there's no balance in the balance sheet if it was the tax on the tax base, okay? So again, the difference, okay, 438. Accounts receivable, the difference between that and what we have in the tax base is, for tax base it'll be more, and it'll be more by the amount that we claim for doubtful debts. So it's that figure plus what we claim for doubtful debts, okay? All right. The difference of that is actually going to be a deferred asset, because typically, you know, when they do fall bad, if they fall bad, basically we'll get the tax benefit of it then, all right? So those are the figures coming through. Unearned sales revenue, okay? We've got that as a liability in the statement of financial position, but for tax base we don't, because we've already recognised that we have earned it, right? So therefore we would be prepaying the tax on that, so that's an asset, okay? Accrued wages are exactly the same thing. We wouldn't have it in the tax-based balance sheet because we've claimed it, okay? Therefore, we won't be able to claim it in the future, all right? Just make sure I've got that, I'm explaining it correctly. So basically it's in the accounts, all right? Yeah, okay. So that pretty much gives us that, okay? It says less prior period deferrals, right? See this one up here? That actually includes what we've already got in the, because we would have already had a balance in there, right? So we've already accounted for that. That's already sitting in the deferral account, right? Okay, so we need to take that off. Okay. Okay, so the total of this column here, the total of all of the total of this one here comes to that, the total of this one comes to that, okay, and the total of this one comes to that. What's the tax on those figures? We calculate that, all right, at 30%, okay. The actual tax payable, we know is that, all right, okay. So therefore, that's the deferred tax, which we'd already calculated up here as well. We know that figure. Okay, so it's just another way to get to the same thing. All right. And if we add those up, right. Okay. So that figure there, you can see, reconciles with that figure there. Okay. Right, so if we were to journal this in, there's a couple, we're going to end up with the same result as this journal here, right? Okay, it's just a bit of a more long-winded way to go, right? So we journal in the deferred tax asset, okay, which is that figure there, okay. We journal in the income tax expense, all right, which is that figure there, okay, same as that figure up there, okay, so it's all working out hokey to pokey so far. The deferred tax liability, okay, is that figure there, and the tax payable, all right, should be that figure there, and that should all balance, right, and it does, okay. Okay, so what we've got now is we've got a deferred liability, tax liability account, we've got a deferred tax account, okay. We can actually consolidate those into one account, right, and we do that simply by posting the smallest balance to the largest balance, right. So we're going to zero out the deferred tax asset, and we're going to therefore we're going to reduce the balance of the deferred tax liability down. All right, where that would just go straight to the, okay. Okay, so what does this mean? In the previous year, we would have started with the balance of what we had already sort of deferred, presuming there's nothing else apart from the depreciation in that previous year. We would have started with that balance. Come the next year, basically we've got that figure plus the 70,000. Okay, that figure there plus that 70,000 comes to that figure. Right, so that's the worked deferred tax sheet, right? So really, I could have come up with that journal by going through this thing here, but by doing this, it's a sanity check that we've got the right figures. All right. There's a few other checks we could do, I suppose. For example, if I sort by column C, okay. Actually, I shouldn't have done that because it's actually got rid of that, which was a formula. Okay, but really, what we could do is we could add up the deferred tax assets and add up the deferred tax liabilities we've got there. Okay, and they should marry up with the figures we've got down here in this in this table as well. All right, probably stop while I'm ahead. Yep.